Let's jump right in. Today, we're tackling a massive headache for accounting teams, and that is ASC 450. Specifically, we're focusing on loss contingency recognition and measurement. If you've ever stared at a pending lawsuit or a messy warranty claim and thought, okay, when do I actually put a number on the balance sheet, and exactly what number should that be? Well, you are in the perfect place. We're going to completely eliminate the guesswork today. Here's our roadmap for this explainer. We'll start with why process absolutely trumps instinct, then walk through a foolproof 4-step decision tree. After that, we'll hit the measurement and range rules, run through a real-world litigation example, and wrap up with the strict mandates of ongoing reassessment.
Okay, Section 1, Process over Instinct, or as I like to call it, surviving the audit.
Let's be real. Doing accounting by gut feeling is a recipe for disaster. You absolutely cannot just rely on instinct here. And whatever you do, do not simply copy last period's classification. Honestly, that's a massive trap. Every single loss contingency needs a fresh, structured analysis at every period close. Why? Because new information changes the whole game. A tiny, whispered risk from last quarter? Yeah, that could be a highly probable multi-million-dollar lawsuit today.
So, Section 2, the recognition framework. Let's look at the 4-step decision tree that's gonna save you.
This right here is your strict, sequential 4-step checklist. You have to apply this to every known contingency. Think of these 4 steps as sequential gatekeepers. Every answer you give triggers a very specific accounting action, and no, you cannot skip ahead.
Step 1, our first gatekeeper. Has a past event created a present obligation? Essentially, we're asking if we're dealing with an actual contingency or just a general, everyday business risk.
The logic is super clean here. If the answer is no, like nothing has actually happened yet to create a real obligation, then it's just a regular business risk. Stop right there. No accrual, no disclosure, you're done. But if the answer is yes, an event has occurred, well, congratulations, you've got a contingency on your hands. Proceed to Step 2.
Step 2 is the big one. Is the loss probable? This is where those 3 core probability categories come into play.
How you answer this completely dictates your next move. If the loss is probable, meaning it's likely to occur, you move straight to Step 3. If it's only reasonably possible, so more than remote but less than likely, you have to disclose the nature of it, but you don't accrue a single dime. And if it's remote, generally, you do absolutely nothing. The huge takeaway here is that only a probable classification pushes us forward to actually measuring a number.
Which brings us to Step 3. We've decided whether to accrue, so now we need to figure out how much. Can the amount be reasonably estimated? Like, can we actually pin a reliable number on this thing?
If yes, you accrue your best estimate and you disclose the nature of the contingency. Pretty straightforward. But what if the answer is no? If the situation is just too murky and you literally cannot make a reasonable estimate, even if the loss is probable, you're limited to disclosure only. You just have to clearly state in the financials that the amount cannot be reasonably estimated.
Finally, we hit Step 4. Is there additional exposure above the accrued amount? This is all about full transparency for whoever is reading your financial statements.
I want you to think of it like this. That accrued amount you just slapped on the balance sheet, that's just the floor. If the full possible loss could actually be way higher than that accrual, the ceiling has to be visible to your readers. You've got to disclose that full potential range so investors aren't totally blindsided later by a massive hit that was way bigger than the booked liability.
So here's the whole logic tree compressed into a nice, repeatable checklist. Probable and estimable? Accrue and disclose. Probable but not estimable? Disclose only. Reasonably possible? Again, disclose only, whether you can estimate it or not. Remote? Generally do nothing. Seriously, keep this matrix handy. It's going to be your ultimate guide.
Moving on to Section 3, measurement and range rules, and how to navigate the traps. When a loss is both probable and estimable, how do we actually pick the number?
It starts with the best estimate principle. If your analysis points to one single, specific amount as the absolute best estimate, then that is exactly what you accrue. Even if you're looking at a range of potential losses, if one specific number in that range is clearly a better estimate than the rest, you book it. Easy, right?
But here's the catch. What happens when you have a range and literally no single amount is better than any other? This is where I see people make massive, painful mistakes. Under US GAAP, the hard and fast rule is you accrue the minimum of the range. You book the lowest number and disclose the rest as additional exposure. But watch out, because under international standards, IFRS uses the midpoint of the range.
Accidentally applying that IFRS midpoint rule to a US GAAP engagement? Yeah, that's a very common, very bad day for an accountant.
Let's look at Section 4, our litigation range example, putting these rules into practice.
Let's imagine your company gets slapped with a messy patent infringement lawsuit. You call up your legal team and they tell you that a loss is unfortunately probable. They crunch the data and estimate the damages will land somewhere in a range between $100,000 and $300,000. But, and this is the kicker, they cannot pinpoint any single amount in that range as a better estimate. It's totally a coin toss between $100K, $200K, or $300K.
So what's the move? Applying our strict US GAAP rule, you have to accrue exactly $100,000. You debit litigation loss expense and credit accrued litigation liability for the absolute minimum of the range. Then, you fulfill your disclosure requirement by calling out the full $100,000 to $300,000 range. That makes it crystal clear to anyone reading the financials that there is an additional exposure of up to $200,000 floating around out there.
All right, final section. Section 5, mandatory ongoing reassessment. Never set and forget.
Look, a contingency is a living, breathing thing. Once you book it, or even if you just disclose it, you cannot just file it away and forget about it. You are strictly mandated to reassess every single contingency at every reporting date. Lawsuits drag on, negotiations shift, new evidence drops. If your estimate changes, you recognize that change right now, in the current period. Do not go back and restate prior periods. To actually survive this process, you need to maintain a highly active, constantly updated contingency tracking log so absolutely nothing slips through the cracks at month end.
So, I'll leave you with this final thought to apply to your own books today. What new information has changed your contingencies since your last close? Have you run them all back through the 4-step decision tree? Grab your tracking log, stick to this framework, and you'll be navigating ASC 450 with total confidence. Thanks for hanging out with me for this explainer, and I'll catch you in the next one.